morning, everyone. What a way to start the day. My name is Valeria Martinez. I'm an investor at VamosVentures. We are an early stage LA-based fund investing in diverse and Latinx founders, building really great solutions to some of the most pressing problems across fintech, health and wellness, future of work, and sustainability. And in the spirit of our conference mantra, do one thing to elevate diversity and entrepreneurship, proud to say our portfolio is 100% diverse-led and 86% Latinx-led. So excited to be here. Welcome to our fundraising panel. We're gonna learn all about the written and maybe some unwritten rules of venture fundraising. But before we get started, let's go ahead and meet some of our great panelists. And let me tell you, you're in for a treat. You'll be learning from some of the best today. So Sara, we'll hand it off to you for some introductions.
Hi everyone, I'm Sara Deshpande. I'm a general partner at Maven Ventures. I joined Maven as the first employee almost 10 years ago in our Fund 1. We're now investing out of our fourth core seed fund, and I specialize in consumer. I believe that we're the best at calling major consumer trends before the hype. So we find very early companies that are backed by bold, when we back bold founders that are building for consumers across a lot of different sectors. So within consumer, we do a lot in communication and digital health, emerging areas like climate and sustainability, clean protein, autonomous vehicles over the years. We're best known for our investment in Zoom. We're the only micro VC fund that invested in Zoom with a very deep belief that video-based communication was going to transform consumers' lives. Zoom went public about 11 months before COVID hit. So it was a wild ride to get to see that from kind of early on until kind of what's happened with work remote. I'm also a GSB alum. I graduated from the GSB in 2009. And so I did other things related to startups for 5 years before coming into venture and joining Maven as the first employee. And I now teach Startup Garage as well. So for folks that are students or considering, it's a super fun class on how to learn about starting a company. And I'm really glad to be here. I was here, I think, at the last one, maybe that was in person pre-COVID. So it's awesome to be back.
Awesome. Thank you, Sara and Valeria. Hi, I'm Amit, and yeah, just fun fact, I'm not the general founding partner, but I'm the founding general partner, right? But it looks like the general partner term is like so misused in venture, like, whew. So, but anyway, so first raise, I started first raise in 2020. This is right at the heart of the pandemic. Nobody wanted to invest in startups in a virtual world. Like, people weren't used to Zoom investing. I decided that's the time to launch first raise. But we're very specific in what we sort of invest in. We are only like how you do consumer. We are only enterprise, and within enterprise, we do only enterprise infra. And that came out of I have an enterprise infrastructure background, but I kind of, when I looked at venture investing, I kind of felt like the pre-seed seed is such an ocean. Like, you can go pitch to any investor you want because you want to fundraise, and a lot of people write like small checks. So like the thesis of first raise was like, no, we need to know what we want to invest in. So because we kind of want to see the trends, and we kind of want to help the company really grow in that space. And me and my partner, like, we understand enterprise infra. We've been in companies like Microsoft and others. Like, so we kind of felt that we should be specific, and we have 4 themes. So if anybody's going to send me an email, which I get unsolicited 10 emails, which I don't respond to every day, is cloud infra, data infra, cybersecurity, and dev tools. It's pretty broad. But within that is where sort of we see our sweet spot of how we actually can invest and kind of add value at pre-seed and seed. We do a lot of pre-seed, but we don't do too many small checks. We write like $1 million or $1.5 million. That's the kind of sweet spot we want to come in with, because we want to be all in within entrepreneur upfront. So, yeah, 20 companies invested so far, a $60 million fund. We still have like 10 more companies to start invest before like next 1 or 2 years. We sold 2 companies in 2021. And this cycle was still bull. One was bought by CrowdStrike, others Netscope. So we kind of understand that we don't have to always go IPO. We can always sell through an acquisition as well. And so that's it. Also a GSBR 2018 class. My classmate is there, Kirsten. Hi. That's it for me. Thank you.
It's so great to be here, everyone. I'm Sydney Sykes. I'm a partner at Lightspeed. Lightspeed is a large multi-stage generalist firm. We invest in just about everything from seed all the way through pre-IPO. I specifically focus on the future of commerce and shopping, so what tools and what companies are going to build the future of commerce. And before I was at Lightspeed, I worked at an e-commerce startup and saw all of the intricacies behind shopping and commerce and everything that's complicated there. Before that, I actually started a nonprofit focused on increasing Black representation in venture capital called Black VC. Founded that and led that for about 7 years before becoming chair of the board. And so I've been really passionate about these issues surrounding funding and diversity and foundership. So I'm really excited for this discussion today.
Awesome. Thank you all. So why don't we start with just some of the setting the groundwork, some of the basics. What differentiates a VC backable versus a non-VC backable business? And why don't we start with you, Sara, if you don't mind me putting you on the spot.
Yeah, no problem. Happy to share. I think, there are a lot of things I love about my work, meeting founders that are doing amazing stuff, like getting to live at the frontier of technology. I can learn about anything I think is cool and call it work. I get to partner with amazing founders and spend time helping them kind of bring their dreams to fruition, which is wildly fulfilling. I love all of that. And when people come to me, they're like, I want to get into VC. That's the stuff they want to do. My actual job is to make money for people. And so at the end of the day, I'm a financial manager. For every dollar someone has trusted me with, my job is to give them at least $3 back. And like, that's the gig. And so, VC at the end of the day it's a math problem. And so when somebody says a VC backable business, what that means is this something that fulfills my promise to the limited partners that entrusted me with their capital and my own capital that we're big investors in our own funds too. And so is this fulfilling the promise of what I said I was going to do regarding, creating, good economic and financial returns. And so at the end of the day, there's a lot more kind of extra credit on VC math we could go into. But for a fund like mine, which will be, let's call it a $70 million fund, just to use kind of round numbers, we need to imagine that we generate over $2 billion in exit value for the companies that we invest in. And so that's a combination of how much cash we put in, how much we own of the company, how much gets invested over time, which may dilute our ownership, and kind of how much that company is acquired for at the end of the day. So across all the companies in our portfolio, we need to imagine, and this is, by the way, to do the job of $3. This isn't to get the 10x return. This is like the 3x return, which is still kind of a top tier fund. So that's kind of the math, is I've got to imagine $2 billion in exits. And the most likely way that happens is one company that exits for over $2 billion. It's not a bunch of companies that exit for $100 million, because it's just as hard to get the $100 million exit as it is the $2 billion exit. So you're just more likely to have this kind of law of power where the bigger exits are driving the returns. And so if you can imagine the math that's happening in a VC's head, when we're thinking, is this a venture-backed company? What I mean is this going to sell or go public someday for $2 billion? And that's the math. And so, there are a lot of companies that can be successful. There are a lot of ways to, live an awesome life as an entrepreneur and to fulfill, building a business. But for a VC fund, kind of with these terms, that's a VC-backed company. That's what that means.
Awesome. Thank you, Sara. Staying sort of on the topic of, early stages, what are some of the strategies besides, like bootstrapping to fund an early stage startup before kind of getting into the VC dollars? Amit, we'll start with you.
Sure. I don't think bootstrapping is bad. There have been so many good businesses that have gone on to raise a lot of. I was looking at Atlassian was bootstrapped for 8 years before it raised the first money outside. UiPath was bootstrapped for 10 years. But primarily, sometimes they were services business, which they thought that they just didn't have what they kind of build as a replicable, scalable product that you want to sort of kind of take out and scale out. And we funded a company just recently. It was an open source company, was run as a consulting gig by one of the founders for 5 years. They have 1.5 million or so downloads a month on their open source version. But one of the founders was like, hey, I just want to do consulting with that. opportunity. They didn't want to build a business. But then there's another founder who came together, and then they said, oh, let's get together and build a product out of this and productize it. And so that became VC backable, right? And so we put the first check in, and now they've got their seed round done. And so it's not bad to say I want to bootstrap. Sometimes you bootstrap because you don't have product market fit. Sometimes you bootstrap because you kind of think that that's not necessarily something that needs so much of cash. I have the necessary talent. If it's profitable, I'll rather bootstrap it than sell. Because at every point, at every sort of fundraising, that you want to think about as a founder that you're selling part of your company to whole of your company, right? So when you're getting IPO'd, you're still selling part of your company. When you're acquired, you're actually selling whole of your company. So at every stage, you want to think about, hey, do I need money to sell some of my company to kind of scale this out further or not? And I think that's if you can kind of do your own math as a founder, you can kind of find the sweet spot between bootstrapping and like fundraising.
Perfect, thank you. Did you have something to add, Sydney?
I was just going to add, I think for a lot of companies, actually probably most companies in the US do not raise venture funding. And you mentioned, owning part of or owning all of the company. If you think about any generational business, that's unlikely to have raised any venture funding. And a lot of those companies either come from bootstrapping, which is basically using the money you make from the business to build the business. But then there's also loans, traditionally how you would think about going to a bank and asking for a small business loan. Or there's friends and family money, which is another way to think about small scale venture funding. Or there's tons of grants. I think that's really popular actually for GSB founders who pursue grants as a form of funding. So there's actually a lot of different ways to consider, and I always encourage every founder to consider other forms of funding before they come to venture funding, because why give away a chunk of your business if you don't have to?
Yeah, that's a great point, Sydney, and I want to stick with you if that's okay. So now that a founder decides they want to raise, it's the right time to raise venture fundraising, what should they be thinking about in terms of preparing for their first institutional funding round?
Well, the first question is why? What is the reason you need to raise venture funding? And I think a founder should have a really good answer to that question, because we're in an age right now where raising venture funding is kind of in trend. It's kind of in vogue, versus historically, venture funding was for companies that had a pretty high risk profile and a pretty high capital intensive business for one reason or another to get to the product that they needed to generate revenue for. So why? How much money are you raising? And then there's the consideration of where venture can be really helpful, which is bringing in the right advisors around the table. So who is the right investor? Amit is a specialist in sort of infrastructure. I'm a specialist in commerce. If you come to me about an infrastructure business, I'm going to be way less helpful than he is. So that's the area where I think venture can be way more helpful than the other types of funding, is bringing in experts who have helped build companies like yours and taking them to the highest level.
Thank you, Sydney. Sara or Amit, anything to add to that?
Yeah, I think that's a really good point of like, how much money do you need? What are you going to achieve with the money, and what's that going to unlock for your business that wouldn't have been possible without the fundraise? And so having that strategy, and then there are tactics to prepare a successful fundraise. And now, in a way that's really different than when I joined. Maven, over the last decade now, it's like VC's jobs to be loud. Like, it's our job to be here and talk about what we like to invest in. It's our jobs to be on Twitter so that people can find us. It's kind of part of the gig. And so because of that, there's now a lot of content that's publicly available around what do investors look for. And there is now kind of a repository of all the successful pitch decks, and kind of here's the 12 slides you should have in your deck. Here's the way you should pitch it. Here's even actually the tactical way to run your fundraise with a pipeline that's going to help you execute on finding the right partner and bringing them in as efficient and successful a way as possible. And so gratefully, a lot of that content is out there. And I think that founders that put themselves in the best position are kind of students of how to run a great fundraising process and build the deck, practice it, pitch it, get feedback, record yourself, get input from people, build your CRM of investors that are targeted, get the right warm intros, or kind of have a really great tactical cold outreach strategy. And you can't control the market, you can't control somebody's fund cycle. There are a lot of things out of your control, but you can control your process. And so to the extent that you can leverage all the knowledge that's out there to do that, I think can really help put momentum in your favor.
Great, thank you. Sara and Sydney, you both said, alluded to finding the right partner, finding the right investor, which is particularly important when it comes to fundraising. What advice do you have for founders to find the right investor, particularly when they may not have connections or warm intros to begin to build the relationships with them? Whoever wants to take this.
Yeah, I'm happy to start. Sara mentioned that part of our job is to come up here and talk about what we're interested in. So I think it's really important to target the investors that show a demonstrated interest in your space. So if you are a fintech company and you're specifically focused on, let's say, credit for, SMB businesses or something like that, you should look not just at investors who are investing in fintech, but have any of them invested in companies targeting SMBs? Have any of them written content pieces about this specific trend? Because the conversation, frankly, is much easier when you're talking to someone who understands the tailwinds, and they're going to be able to provide better advice. So I think that's the best approach. And a lot of times what I tell founders is, don't just look at the fund, which is hard for me to say as someone from a very big fund. Don't just look at the fund, but look at the specific investor that you would want on your cap table, and you're gonna have much more success with a cold outreach that way, targeting them, explaining why you're targeting them. So I don't think cold outreach is a no-go. I think it's worth it as long as you're targeted and thoughtful, but the truth is, in venture, nothing replaces a warm intro. And so if you're able to reach into your network and contact friends of friends, people from the GSB if you went there, or from your college, or who have that connection, try to utilize those as much as possible, and don't be afraid to ask for a favor if it's going to get your business to the next level.
And one of the sources of warm intros that is overlooked sometimes is other founders. I actually get a lot of referrals from founders who pitched me, and we didn't invest in their business, but usually that's more a reflection of our thesis in that moment, because we'll look at well over 1,000 companies a year to make 6 investments, and so like a VC is just a professional no-sayer, and it's just like our job to say no to everybody all the time and try to do it in a way that then that person still will refer you companies later. And so going to founders and asking other founders in your network, who did you pitch? Even who are your investors that you really love? I mean, that's huge, if getting an intro from somebody that did invest in their company. But who are the investors that you pitched that gave you good feedback, or mentioned that wasn't a space that they might like this space, and you can kind of build your pipeline of investors through that. So tapping your network of other founders, I think, is really useful. And then the second thing is understanding the math of someone's portfolio and their own investment strategy is really important. When people come to me and they're pitching, for example, like, oh, we're raising a seed round, we're raising an $8 million seed round. I'm like, okay, I'm a seed investor, but my fund size means my check size very similar. You're like, your check is $1 to $1.5 million. My check is $1 to $1.5 million. We have similar fund sizes. And so if you can kind of get a sense of what is someone's fund size, what is their average check size, I just can't lead an $8 million round. So that's just a no-go, because I'm not going to get enough ownership. And if I invest $1.5 million, they're still going to have to raise another, call it $6 million on top of what I give them. Like, that's not the strategy. And so if you can kind of get a sense of the portfolio construction and the check size strategy, I think that can be a helpful qualifier as well.
Yeah, and I think another way to think about this, and I think both of them have kind of alluded to this, that you need to do a lot of founder hustle in terms of like fundraising not going to go away. If you want to raise venture, you got to probably raise pre-seed, then seed, and then Series A and Series B. It's just going to go on. As a founder, you need to first accept that, look, you need to be out there. You need to network. You need to be present in so many, maybe meet investor in different forums, like maybe go to a Lightspeed event, and maybe go to a Maven event, and kind of find the right sort of people. And another way, I think, is also start putting content out there where you can be seen as a thought leader, right? I really love people who say, hey, look, we have a perspective on the space. It may not align with my perspective specifically, but it is a perspective on the space. There are today ways to do it. Like, you can put an open source product out there if you're on the enterprise side. If you can write blogs on your, what's the sort of gap and the white space that you're sort of attacking. You can kind of start doing partnerships and put it out on a marketplace and test out your early beta product or whatever, right? So you can put it on Product Hunt and things like that. So I think there are ways to sort of kind of amplify your venture and your own personal profile, which I think it's also very important, like to kind of signal, like having advisors, talking to even people who've worked in the past who can probably have connections into the venture ecosystem is super useful. Like if I've had a manager who went on to being part of an IPO company and he probably like presented to the board, I would want to reach out to them and want to tell them, like, let them know to the investor about my track record as how I am as an engineering manager or whatever. Right? So things like that, being out there is extremely important, I think, for founders, not just early on, but throughout the entire journey.
Yeah, thank you all. So I think what I gathered from that is really look for the investors that are already looking for you. Look for the investors that are investing in what you're building. And then, of course, build a brand and begin to build a relationship that way. So for Sara, once you've identified the right investor and you have a meeting with them, what are some tips you can give for a great pitch and to leave a really good impression?
It's a great question. First, make sure you're comfortable. We do pretty much every first meeting. We do 30-minute first meetings on Zoom pretty much all the time. And so make sure you're comfortable, pitching on Zoom, that you've practiced, that you're, polished and ready to go for that. And on the actual pitch itself, really lean into, in that first kind of, introduction of your company, you've got to convey kind of what is your vision worth fighting for? Like, what is this thing that needs to exist in the world that's worth all the effort and the time and the money and the energy that's going to go into making that happen? And like, how is that, not to be cliche, but like, how is that going to make people's lives better? Like, why does that matter? And if you can convince somebody of that promise early on, they're leaning in to hear about, okay, how are you going to do it? Like, what have you accomplished so far that's proof? Why am I going to believe in you as the leader of this? But you've got that kind of early, moment in the pitch to really get someone leaning in on your vision. And so I think that that's just really, really smart to do is get somebody excited about the vision and opportunity as kind of the initial, piece of the pitch. And the last tip I'll give is a pitch is not the place to break the mold. Like, break the mold on why your team is awesome, break the mold on what your unique insight is that nobody else knows, but don't be cute with the pitch itself. Like, I want to know, what's your vision, what's the problem, what's the solution, who else is doing this, why are you going to win, why is your team going to be the one to do it? Like, just give me the stuff I already want to see, And so if you can, put yourself in the upper right-hand corner of your competitive matrix, give people what they're looking for, and then they're spending their mental time about, what's special about this opportunity, and not where's this going, and having to work hard to kind of interpret your pitch. So really let the things that are unique about you shine, and kind of try to keep the template and the model that people are expecting, follow that.
I'm happy to add. I think this is going to be a tough piece of advice that's a little bit hard to truly internalize, but a pitch is not adversarial. It's not you versus the investor. I find the toughest pitches I experience are a pitch where the founder feels really defensive, where I ask them a question of the business and say, well, you're not thinking about it the right way. Here's the actual challenge. Or, actually that's not right. Like, this is right. It's okay if there's a flaw in your business. In fact, if your business was the perfect approach, someone probably would have already done it. What I want to know is, how are you thinking about the business in a different way than anyone else? And how are you going to conquer the challenge that makes it so difficult that no one else is able to do it? And so I think it's really important for founders to sort of let down that guard a little bit and be open to saying, you know what, that actually is a challenge, and I've thought about it a lot. And here's where I think we're going to be able to beat that challenge, not know that challenge doesn't exist.
That's such a great point.
Yeah, thank you so much, Sydney. The other thing, if I can add to what the panelists have already mentioned, I think it's important as a founder to recognize that you know your business, more than anyone. So going into that meeting with that type of mindset and confidence, right? That you know your business, you know your industry, and like Sydney mentioned, being flexible to the dialogue with the investor and really making it a conversation. So would like to move on to timing when it comes to fundraising. Given the current economic environment that we're in, What would you say to founders in terms of the timeline of their fundraising? Should they wait to raise when things are more favorable, if they can, given cash runway? What are some thoughts? Amit, I'll hand it to you.
Yeah, I mean, it primarily depends on the stage at which we are. Like if you're fundraising for the first time, I think it's still a great time to sort of say, hey, look, this is a brand new venture. We haven't started. There's no cash to be burnt yet. So obviously it's going to be fundable if the idea is fundable. And I think that is the classical way in which you would still go. So what we see in the market is, I think pre-seed, seed is still getting funded significantly. I mean, there is definitely going to be a slowdown, but it's not as bad, it's not brutal. But really raising for Series A, the bar has become higher. And Series B is really hard to get growth capital, right? Series B onwards is really hard. Probably it's going to be flat valuation rounds, or depending on how your Series Bs happen, right? So, but if you're really looking at how you want to go, if you're an existing firm and you have raise some money, and then you're looking at the next, say, maybe additional capital in. So I think there are a few ways to sort of differentiate yourself. One, execution. 2, execution. 3, execution. Right? So if you're saying that, look, you've actually done something with the money that you have, you actually have the right to raise for. That's how the market is today. Early it was like, hey, look, on the promise, I built something, I still have some way to go, and can you add a bunch of capital in? Is a great way. But right now you got to show, so things like, even at early stage, it's really hard to say net new revenue, right? But it's still, if you can actually demonstrate you've actually started like generating net new revenue, that's a great way to say I'm executing well. You think that you've got a product niche, you've got the GA of the product then, and you've got to sort of be able to sort of position it to enterprise customers, then it's again a great win. So I think right now the market is such that you have to differentiate yourself if you've already fundraised through execution and metrics.
Great. I don't know if there's anything else to add?
Well, I just don't think you can time the market, and I think that you should raise when you're ready to do that, and when your business is in the position to put that capital to work. Seed and pre-seed is healthy. It's taking longer. Series A and Series B and later is very, very hard right now, but deals are clearing. They're at lower valuations. They're smaller round sizes, and they're taking longer to get done, but they're happening. But it's hard. There's also a lot that aren't happening that would have happened 12 months ago, and so that market is challenging. But seed and pre-seed, the conversations are taking a lot longer. That's probably healthy, but they're certainly they're certainly happening. I would love to say that wait it out is an option, but I don't really honestly believe that's true. Like, I think it's very possible that the private markets, the private fundraising environment gets worse before it gets better. I think there's a lot of companies that have tried to do wait and see, and venture funded companies only have so much runway, so wait and see doesn't last forever. So if you've been waiting and seeing for 12 months since the market started to turn 12 months ago, like, you can't wait and see anymore. And so all of those companies are either going to go out of business or they're going to come to market. And if everybody comes to market, a lot of deals are going to get done and a lot of deals aren't going to get done. And so it's, we can't predict it, but I don't have the confidence to say fundraising will get easier in the span of time that it matters for high growth businesses to say you should wait. So you should put yourself in the best position and your company in the best position and raise when you can. But Sydney's the only one at a multi-stage firm, so maybe you guys are seeing, you probably see more data from.
I think everything you're saying is true. Series A and beyond is harder than it's been, but those deals are getting done if there's good economics. I think the biggest lesson learned is a lesson in fundamentals around fundraising. A lot of companies raised at really high valuations in 2020, 2021 because they could. And now they go out to raise and they haven't lived up to the multiple. If they were getting a 10x multiple and now that wasn't super justifiable back then, now it's less justifiable if you haven't grown that 2-3x that you thought you would. And so I think it's a lesson in, one, when you fundraise for about 2 years of runway. Don't fundraise for less than that because you're optimizing for changes in the market or valuation. 2, when you're fundraising, valuation is not the most important thing in the world. The truth is, cash is what keeps businesses alive. If you don't have money, you die. And so raise the right amount of money from the right partners. And we're just seeing the consequences of that right now. So if you're going out to fundraise, really think about how much money do you actually need and what valuation is the right valuation for your business.
Thank you all. How do you find a lead investor? So you have your why, you're executing, you're showing traction. How do you go about finding a lead investor?
I'm happy to start there. It's like matchmaking. It's like, how do you find your husband? Like, sometimes you meet them at the market, sometimes you meet them at Burning Man. So I think a really good place to start is by finding the people you would either want to hire or would want to be your investors, or would want to be your advisors, because those people could be either angel investors or they could be intros to the right people. Like I think rarely, you guys tell me if I'm wrong, rarely is it that the lead investor is the first check into the round. It's usually that there's like an angel investor in, or there's an advisor who's been in earlier. And so I think it's good to start with having those conversations with people who you'd want to be advisors or investors in your business, and then you go through and you create your pipeline. Sarah mentioned this, but you can go online. There's kind of a well-done strategy for how to run your fundraising process and how to search for the right investors.
I met my husband in Las Vegas, so I don't recommend that. It worked. I don't know. So I don't recommend that for finding your lead investor. But I think to the pipeline, just to put some numbers around it, we used to think people had to probably talk to maybe 40-ish, was kind of like 40-ish was like kind of a good number. I think that's probably close to doubled in this market. So I would expect you're going to have to talk to probably more like 70 to 100 funds to find a lead investor. And if you go in with that mentality, maybe it happens for you in the first 20 conversations, and that's awesome. But I think the reality is you've got to kind of put the armor on and be prepared that you may need to build a pipeline of 100 firms and talk to 100 people to get a lead investor. And you'll get better as the process goes. And so in some ways that's just practice, and it's like learning how to pitch the vision of your company that's going to help you recruit people down the line, and to sell to customers and all of those other things. And so I think you just have to embrace it as a learning opportunity and expect the pipeline needs to be probably quite large.
Yeah, I can add. I like what Signy said. So I think you want to see if it's first time you're fundraising and you're going to do brief. I mean, you have to decide what sort of amount you want to go for. Like, is it going to be $1 million for you to kind of show something out there and then go and raise from a genuine top tier fund, or is it going to be like you want to go and upfront raise a $5 million, $6 million? Like, it depends also on the kind of team you're assembling who are coming together. And the kind of problem they're trying to solve. Like if it's a harder problem, if it's a bigger team, you probably can go and pitch to Lightspeed and say, hey, look, we've kind of cracked this. This is a huge insight. We have 5 guys, or whatever, 5 people, and then the question is, and then hope that one of these top tier funds would sort of do that larger seed round. Or you can go and say, look, the other way around is like, hey, go find like angel investors, advisors who are kind of saying, hey, look, we have a thought process on the space. We can kind of help you execute a little bit, and then you can raise a little bit of money and then do it's probably like a friends and family round, or even like an angel round to start with, and then and then there's an in-between thing where there are like funds like ours, like where we like pre-seed or seed, who kind of write that $1.5 million, and then kind of gives you a couple of like maybe an 18-month runway if you want to raise $2.5 million, and then get to a point. So I mean, there are various strategies to do this. But then the key thing is, if you want to find the lead investor, you want to find funds who actually write lead checks, not funds who are going to drop a 50K check or a 100K. There are lots of funds who will talk to you, but essentially their strategy is like write a 100K check or a 150K check. Like Y Combinator is like that's a classical way. A lot of funds that are YC oriented funds, they just come at like 200K, 300K. Now that could be a strategy you could do, but something that I don't like personally is like I don't like a party round. Typically early on, it's possible you can manage all investor expectations. It just kind of doesn't give you enough to sort of, hey, you're going to deal with 5 to 6 investors, all of small checks. When are they going to get checked out from your business? We don't know. When are their own like other priorities take over? So the question is, how do you sort of want to sort of strategize your fundraising? Depends on the fundraising amount, the kind of team that you're kind of taking, the kind of product and the market that you're sort of addressing, and then who is sort of the right sort of partner for you. And to Sarah's point, like if you're going to go after 70 to 100, I would always say do it in batches. Like go to the first 7, 10, get feedback. Like really, Where are the positives? Where are the negatives? Ask them for feedback. Like if they say, oh, you're too early for us, what are the metrics they're looking for to make you for them to sort of get you over the line, to at least take them to the investment committee and things like that. So, and then sort of rework, reiterate, and then can keep going back and forth. So that's.
Thank you. I want to shift the conversation a little bit. So last year, VC funding fell about a third, and diverse founders were disproportionately affected by that decline. So Black founders went from receiving 1.5% of total VC funding to 1%. Latinx founders went from receiving 2% to a little less than 1.5%. So of the $200 billion plus that were invested last year, those are the metrics. So for the panel, fewer dollars are being allocated to diverse founders. So what advice do you have for founders who are currently raising and are having a hard time? Fundraising isn't going according to plan.
Yeah,
It's hard.
Sure. Do you have something you want to start?
And I mean, it's hard, and I think most companies are in that stage right now, and disproportionately, it's even harder for underrepresented founders, and so, it's hard across the board, and I think the reality, I would want this not to be the answer, but until the game changes, and the stats are showing the game hasn't changed, you have to play the game that's on the field. And so that's what is here. And so I think taking, all of the advice we've mentioned around building the pipeline, running that process, leaning on your network, asking for favors, talking to, the most unlikely sources, other founders that have maybe also had unsuccessful fundraises, like build that network and support system, ask for leads from each other, and figure out how you can, gather, all of the best network and resources that you can, because when it's a hard market across the board, I mean, the data's showing, and I think, personal experience is showing that definitely impacts, underrepresented founders more. And so I think you have to, continue that. And also, be willing to, think creatively about how you extend your own personal runway, because I think this idea of, oh, it's a bootstrap business and like raise money from friends and family, like, not everybody has friends and family that can, I certainly didn't. And so, like, how do you figure out your own network? Can you extend your personal runway in other ways, through other employment or, consulting or advising or, thinking creatively about what's going to allow you to continue to pursue this vision? And if the capital is not coming in that way, what are other ways that you can think about extending your personal runway to allow you to still be able to extend that vision? And you kind of just have to keep at it. Like, if people think, oh, I got 20 no's. Well, we just said you're gonna have to talk to 100 people, so you've got 80 more people you can talk to, and you might kind of get that yes. And so, I think acknowledge the reality of a hard market, and we're all built to be optimists, otherwise we wouldn't be here. And so I think you just have to retain that optimism that you're gonna be able to do it, and just keep trying, because deals are happening every day. It's really hard, but they're happening all the time.
Yeah, I'm happy to add to that. I think this is definitely a tough time for underrepresented founders. What we've seen in general is that in times of uncertainty, bias comes out more. And that's really unfortunate, to put it really lightly. But I think one thing that's a little bit hopeful is, compared to 3 or 5 years ago, we have much more seed funds and pre-seed funds in general, pre-seed funding, seed funding. And 2, there's more funds led by women, people of color, et cetera, especially at the seed. And so there is an opportunity there to connect with an investor who looks like you to get the truth of the situation. I think the other thing I would advise is to make sure you have those advisors or potential investor conversations that are very candid. Because what you do want to understand is, yes, there is bias out there, but is there something about the business that's maybe a flaw you're not hearing in your pitch conversation with later stage investors, because they don't have the time or the relationship to give you the depth of the answer that you need. They don't have 2 hours to give you. So I would really make sure you're understanding the full angle that the investors are coming from. And then, like Sara said, other forms of investment, loans, grants, incubators are still great. Accelerators, still great. Accelerators besides YC, still great.
Great, thank you, Sydney.
I think it's important to realize that the money is there. I think like what Signy is saying, that there is obviously there are going to, but can you as a founder, like rework the numbers? Can you be more like, can you cut the burn? Can you show more like, hustle and say, hey, look, earlier probably I would have raised 5 million. I understand the market's tough. Maybe we raise 2 million instead, right? Can you kind of rework the whole, like, I think the part of the reason, and this is true for not just 100% business, like many founders are not able to recalibrate when it comes to kind of redefining the path forward, right? So yesterday I was one of the, in a company where like one of our companies wanted to acquire a fintech company that sort of like has an emerging market presence. And then they had backed by some really fantastic investors. And I asked them, why don't those investors want to reinvest in the company? It was a great growth company and they had raised a lot of money. And they said, no, they just don't want to spend money in a market like Nigeria, right? Because earlier they had it because the times were great, and now they shut down the emerging markets fund, and so they don't want to reinvest. Now there's one way to look at this and say, hey, look, I don't have my existing investors backing. Another way to look at it is like, who are the people who are willing to sort of reinvest in a market? Can I just move out of my comfort zone of being in the Bay Area and go and fundraise outside and things like that? I think a lot of that hustle has to come out a lot more, and it's harder at this point. And I think that would probably kind of differentiate.
Yeah, thank you all. Sara, you mentioned something that stuck with me. We've got to change the game. We've got to play the game, but we have to change it as well. So as investors in the room, we have the opportunity to change the game. So in spirit of our conference mantra, do one thing to elevate diversity and entrepreneurship, what can we be doing as investors? What can investors in the room be doing to elevate diversity, to change that game? Whoever wants to take this.
We've done a couple tactical things. The first is actually looking at and measuring in our portfolio what does it look like? You're not going to make what you don't measure. And so when we look at our portfolio and we see well over half of the companies that we've invested in have diverse founding teams, like that's really encouraging. But it wasn't by accident. And I think if you look at the number of like female founded and female CEOs in our portfolio, that number is wildly higher since I became a deal lead at the firm. Not because I invest in female founders. I think maybe because there's a different rapport or openness or comfort level or just understanding, or the categories that those women were building in were more appealing to me, or I understood the growth opportunity in, for example, fertility companies or companies targeting women in menopause or whatever. I think that's very real. And so part of it is measuring. And then the second thing, I thought about this a lot, especially over the last few years, and what tactically could I do? I'm like, okay, I can't change anything that's in the portfolio now. Like, what tactically can I do to say I'm doing something to try to change the game? And so the specific thing that I do is anytime I'm leading a deal or one of my great companies is going on to raise follow-on capital, I make sure the roster of investors I'm sharing that great opportunity with are diverse. And when I'm looking for opportunities, I make sure I have very rich and deep relationships with a bunch of investors who don't all look like me. And I think that those people are tapping into other networks. I'm tapping into different networks. And so being able to share that deal flow and share those investment opportunities, I think that's like where the real bonds and relationships are made, is when companies are doing well or aren't doing well, and kind of being in that room with other investors and working with them has been an area where I've just learned an immense amount. And so I can tactically make sure that all the deals that I'm sharing are at least getting in front of a diverse roster of investors. And if I don't have a diverse enough roster of investors, that's my job. And I need to go and broaden, the network that I have to make sure that there are more than ever before, And so like it's my job to really try to cultivate that in service of our founders. And so as investors, for folks that are thinking about being investors, that's an advantage that you can cultivate, is make sure that your own network reflects the network that you want to get very, very wealthy when these companies are successful.
I love that. Anyone else want to chime in?
Yeah, so I think it's for us again similar. Like being a small size fund, we have an internal goal and we have an external goal, right? The internal goal is, although we are like two Indian origin founders, we want to have the next person in the team diverse, and especially we said, okay, it should be a women partner on board. Now, women in STEM is harder to find, but there are a lot of people who want to have a career investing. And we said, hey, specifically women who have that enterprise background, who want to have a career investing. That's where I think we're going to look for the next partner on board. Like, so that's an internal goal that we've taken. And it makes total sense because it's a very different perspective that we can sort of. So that's one starting point. And then the external goal is like how you're saying, like how can I start looking at diverse ways in which I can still be in the same thesis, but look at diverse teams who are sort of presenting, and we did like switch out and say, hey, look, there was a Stanford GSB, 2 women founders. We didn't make an investment. It was slightly adjacent. We didn't think that was a core infra, but we did make that push and we made that initial check and kind of tried to be helpful. But we still are looking for like, hey, if they're solid teams, solid founders, and then obviously all venture funds are also sort of looking for the same, and it has to work out in terms of the round math, and we have to be there at the right time, right place, and a lot of things. But that's the external goal, to be able to sort of, at this point for us, to be able to say, hey, look, can we get to more women founders specifically in the enterprise side, which is really hard, and that's where I think we've sort of set ourselves an external goal as well.
Yeah, thank you.
Yeah, one thing that I found is really impactful was to rewind. When I was at NEA, I was in a pitch meeting with one of the partners, now the head of the consumer practice, and we were flipping through, a company's deck the way you usually do, and we got to the team page, and it was all white men. And he just casually asked, what's your plan for making your team more diverse? He's not saying like, hey, for us to invest in you, your team needs to look like this, or we only invest in teams that look like this. But he was showing with his question that like, we believe in diversity as a priority for a business, and I want to know how you're thinking about the future of your business in that context. And so I try to think about those kind of small mindset shifts that are really important, not just because I think that the challenging part is it does put a little bit of pressure on the founder, but I think the more important thing is almost all of the companies we invest in come from a startup. And so if all of the startups in our portfolio or all of the startups in Silicon Valley look a certain way, it's going to be really hard to find the next generation of founders from that pool of talent. So it starts with your portfolio companies, it starts with the companies you decide to invest in, and then it ends with how we support our companies to look the way this industry should look.
Yeah. That's great.
I love that a man asked that question too. It's like it takes everybody to lean in to ask the question. Yeah.
Totally, and it makes it easier for people who don't look like him to ask the question.
Absolutely. Representation matters. So I think that we have time for maybe 1 or 2 questions. I see the sign back there. So, yes, right here.
So I have a question like corporate venture capital versus regular VC. When you are a B2B company, which one you will go first? And what's the pro and cons? Second question, you mentioned about accelerator programs, and there's so many out there. How should the founders pick? Because some are really time consuming. Third question is, Dad mentioned about women included in the founder team. Those companies perform better than only male team. Is there research showing like if it's all female founders, what's their performance looks like?
The first part of your question was venture capital versus
corporate CVC, corporate venture capital.
I can take that.
Yeah.
I've run a CVC before. So I would say CVCs are strategic capital essentially. They would want a lot of strategic alignment with what the company is doing before they decide to invest. So it's going to be a longer time horizon. There are obviously good CVCs at later stages, like Series A, Series B, who come in with a lot more growth stage capital. So I would say CVC not in your early stage, but look at CVCs later stage. CVCs as part of your round, not your lead of your round. So those are the kind of things I would say between CVC and VC. I would still go for VCs as the sort of the lead investor, and then CVCs to sort of fill out a round because they have strategic interests and they take a bit more time than a VC would give you as an answer.
I'm sorry, I think there was a second part to your question. Accelerators. That's
yeah,
right.
I think it's a great option. YC still, I think, carries the brand that's most recognizable by most VCs that write capital, and so I think that's a great option. It's not the only option, and I think TechStars has done a lot to specialize their programs. And so if you're in healthcare, if you're thinking about getting into an accelerator, what do you want from that? And if you look at their programs, for instance, they're specialized with Cedars-Sinai or United Healthcare or something like that. And so those partnerships and relationships can be helpful. So those are just a couple of examples. But there's also a lot of other either regional or specialized accelerators that are out there. My advice on if you're going with something that's not necessarily the national brand is to make sure you're getting like actual cash and money. That I think sometimes there are equity only accelerators. I've never been a big fan of that model. You also got to get cash to run your business and pay yourself and your team, and talk to other founders that have been through the program and reference what that experience was like for them and if they would do it again.
Yep, I've not much to add. Just on both of those, do references on the firm or the accelerator. That's the best way to know if it's a good fit.
Great, thank you. And we have time for one more question. I think I see a hand back there.
Hi, I'm Hannah, co-founder of Spaciously. We run experiential retail at scale. So as VCs, you guys have broad knowledge of the market, and I would love to learn from you, but I know you're also strapped for time. So what is the best way to kind of learn from what you know about the companies out there on the market?
I'm happy to start there. Sorry, by the companies on the market, do you mean about competitors?
I'm just curious about the new companies in the retail space, for example, and what's going on, because you have kind of knowledge of the companies that are not in the news yet, they're super early. I would love to learn from that.
Yeah, it's a good question. So couple different answers. Sorry, my phone is acting crazy. Anything you want to know from VCs, frankly, the best way to get that information is to have very specific asks in a short email. Hey, Sydney, saw you're spending time in retail. These are the 3 questions I have. Frankly, that's always the best way to get a response. But like hey, I want to chat, I want to pick your brain. It's a tough way to get a response. The second question is around, or the second part of your question was specifically around like understanding the competitive landscape or understanding the landscape of a space. I think content put out by VCs is a good way, but also just talking to the potential customers. Because what we do is we go and talk to the customers to understand a space better. So the customers are going to be the ones saying, actually, I've looked at all 5 solutions in this space and here's my perspective on them. So I'd start with the customers first.
I also talk with a lot of founders that aren't maybe yet fundraising, but they're in categories that I know a lot about and would want to fund something in. And so if you find investors that want to fund things in your category, they probably do want to get to know you and learn from your insights and kind of understand that as well. And so those conversations, whether it's over email, like specific questions and starting in that way, or like I just want to share with you my background and my vision and what we're building so that we can start a conversation now before our seed fundraise in 6 months. Those types of conversations as well. And if it's an area of deep interest, which I'm guessing if someone were reaching out to me because of my knowledge, it probably is, I have a lot of those conversations too.
Thank you so much for spending your morning with us and for all of the insights. I'm sure we all really appreciate it. Thank you so much.
Great chat. That was good.